So picture this. You've been saving for years, like years, skipping vacations, packing your lunch, saying no to things you actually wanted to say yes to. And then one day, you finally hit that number, the down payment, the pre-approval, the whole thing, and you walk into your first home, key in hand, and you think, I made it. You unpack your boxes, you stand in your kitchen, you maybe cry a little, no judgment, I've heard this story more than once, and for about 3 weeks, life is genuinely beautiful. And then the water heater makes a noise. Not a terrible noise, not an evacuate the building noise, just a noise, a groan, a wheeze, the kind of sound that when you're renting, you'd just text your landlord about and forget. But now you are the landlord, and suddenly you're on YouTube at midnight watching a 45-minute video about anode rods and sediment buildup, wondering how you went from celebrating the biggest financial achievement of your life to panicking about something you didn't even know existed 3 weeks ago. That moment, that exact midnight YouTube water heater moment, is what nobody talks about when they talk about homeownership. My name is Emmy, and I spend way too much time thinking about money, financial psychology, and the gap between what people expect their financial decisions to cost and what those decisions actually cost them in real life. And the gap in home ownership? Honestly, it's one of the largest I've ever seen. Not because buying a home is bad, I want to be really clear about that, but because the story we tell ourselves about it, the numbers we plan around, almost never include the part where the house needs things, expensive things, inconvenient things, things that show up without warning and demand your attention, your time, and a surprisingly large chunk of your bank account. So today, I want to walk through all of it, the real cost of owning a home. Not the mortgage payment, not the down payment, but the deep, dark, slightly terrifying iceberg of costs that live below the surface. Because if you understand them, truly understand them, you'll plan better, stress less, and maybe even feel a little smarter the next time your water heater makes a noise. Let's get into it. The mythology of the mortgage payment. Here's the thing about the mortgage payment. It's clean, it's predictable, you know it on day one, it doesn't change, assuming a fixed rate, and it fits neatly into a budget spreadsheet. And because it's the big number, the number you fought to qualify for, the number you negotiated around, it becomes the number you psychologically associate with the cost of your home. But the mortgage is not the cost of your home, it's just the beginning. Think of it like this. Imagine you're buying a car and someone tells you the sticker price. You agree, you shake hands, you drive it off the lot. But nobody mentioned the gas or the insurance or the oil changes or the fact that tires need replacing every few years and brakes need servicing. And at some point the transmission is going to do what transmissions do. You'd feel a little cheated, right? A little misled? That's home ownership for a staggering number of first-time buyers. The mortgage is the sticker price. Everything else is the cost of actually owning the thing. So let's start talking about what everything else actually means, because once you see it laid out, really laid out, it becomes much harder to ignore. And ignoring it, by the way, is exactly what most people do, not because they're irresponsible, but because nobody sat them down and said, hey, here's the full picture. Property taxes, the bill that never stops. Let's start with property taxes because this one sneaks up on people in a way that's almost poetic in how avoidable it is. When you buy a home, the lender often, though not always, rolls your property taxes into your monthly mortgage payment through something called an escrow account. So you might be paying, say, $2,100 a month and think of it as your mortgage, when actually $300 of that is property taxes and another $150 is homeowners insurance. This is actually fine, it's a decent system, but it creates a psychological blind spot. People stop thinking of taxes as a separate expense because they don't write a separate check for them. And then the reassessment happens. In most places, when a property changes hands or at certain intervals, the local government reassesses its value. And if values in your area have gone up, which they probably have because you bought in a market where you expected them to, your property tax bill goes up with them, sometimes significantly. I've talked to homeowners who bought a house in a neighborhood that appreciated sharply, and within 3 or 4 years, their property taxes had increased by 40%. Not their home's value, that actually felt great. Their tax bill, the mandatory annual payment that keeps going up whether you have the money for it or not, and that you can't negotiate or delay without risking a lien on your property. And here's the uncomfortable kicker. In most U.S. states, there's basically no cap on what property taxes can do over time. You can own your house outright, no mortgage, completely paid off, and still find yourself priced out of it by a tax bill you can no longer afford. We don't talk about this enough. It's one of the reasons why I'll pay off my house and then my housing costs will disappear is, not quite how it works. The takeaway here is simple but important. When you're calculating what a home will cost you, look up the current property tax rate for that area, build it into your budget separately from the mortgage, and then add a mental buffer for increases, because they will happen. It's not a question of if.
Okay, insurance. I want to spend some real time here because this one has layers. So most people know they need homeowners insurance. Lenders require it, which means you pretty much can't skip it even if you wanted to. And most people get their policy, see the premium, add it to the budget, and move on, which is fine. But the cost problem with homeowners insurance isn't just the premium. It's the gap between what you think you're covered for and what you're actually covered for. Standard homeowners insurance covers fire, wind, certain kinds of water damage, theft, and liability if someone gets hurt on your property. What it typically does not cover, and this surprises people every single time, is flooding, even if the water came from outside. Even if a river overflowed a mile away and soaked your first floor. If it wasn't from a sudden internal pipe failure, standard homeowners insurance usually says, "Not our problem." Flood insurance is a completely separate policy, administered federally in the U.S. through FEMA's National Flood Insurance Program, and it costs money on top of your regular insurance. And here's the thing, a lot of homes that are in low to moderate flood risk zones don't get it, because the owners figure we're not in a flood zone, we're fine. And then we get a year with unusual rainfall or a drainage system that can't keep up, and suddenly people are learning what low flood risk actually means. Lower probability, not zero probability. There's also the issue of insurance premiums rising dramatically based on where you live. Homeowners in Florida, California, Louisiana, states with high wildfire or hurricane risk, have watched their premiums double or even triple over the past decade. Some insurers have exited those markets entirely, leaving homeowners scrambling for coverage through state-backed insurers of last resort that often cost significantly more and cover significantly less. If you're buying a home today, I cannot stress enough. Get real quotes for all the insurance you might need before you close. Fire, flood, earthquake if you're in a seismic zone. Call actual insurance agents, not just comparison websites, and budget not just for today's premium, but for the very real possibility that it goes up, sometimes dramatically, in the coming years. The 1% rule, and why it's both brilliant and incomplete. Now we're getting into the part that really matters for most homeowners, the ongoing maintenance and repair costs. Because a house is not a static object, it's a living system of components, each with its own lifespan, each requiring care, and each capable of failing at spectacularly inconvenient times. There's a rule in personal finance, probably you've heard it, called the 1% rule. It says you should budget roughly 1% of your home's purchase price per year for maintenance and repairs. So, if you bought a $400,000 house, you set aside $4,000 a year, or about $333 a month. It's a nice, clean heuristic, and for a newer home in a stable climate, it's honestly not bad. The problem is that the 1% rule gets slippery fast when you factor in home age, location, and what I'd call the deferred maintenance inheritance, which is the technical term I just made up for the previous owner didn't fix things and now it's your problem. Older homes can run closer to 2 to 3% annually. A $400,000 Victorian that's 50 years old might genuinely need $8,000 to $12,000 a year in ongoing care, not because something catastrophic happened, but because older homes have older systems, older roofs, older wiring, lead paint and asbestos in places you really don't want lead paint and asbestos, foundations that have settled and shifted over decades, things that were built to standards that don't exist anymore. And the deferred maintenance piece is something buyers consistently underestimate. When you're touring homes, you're not a contractor. You're looking at staging and natural light and whether the kitchen layout works for how you cook. You are not looking at the age of the HVAC unit or whether the caulk around the windows has dried out. A home inspection helps, genuinely it does, but even a good inspector is looking at what's visible and accessible. What's inside walls, under slabs, behind panels, that's another story. So the 1% rule is a starting point, not a ceiling, and it absolutely needs to be money you actually set aside, not money you plan to find if something breaks, because something will break, always. The universe has a sense of timing about these things. The big ticket items, and their surprisingly predictable lifespans. Here's what I find weirdly comforting about the scariest homeownership costs. Most of them are actually predictable. Not the timing, you can't know if your furnace dies in December or March, but the inevitability. Every major system in your home has a lifespan. Once you know those lifespans, you can see the costs coming, even if you can't see the exact date. Let me walk through the big ones. The roof is maybe the most notorious. A standard asphalt shingle roof lasts somewhere between 20 and 30 years, depending on climate, installation quality, and how much weather abuse it takes. Replacement costs vary enormously by location and roof size, but you're generally looking at somewhere between $8,000 and $25,000 for a full replacement. And here's the thing, you can't skip it. A failing roof lets in water, and water destroys everything it touches. Insurance typically won't pay for a roof that failed because it was old. That's a maintenance issue, not a sudden loss. It's on you. HVAC systems, your heating, ventilation, and air conditioning, last about 15 to 20 years. Replacement costs tend to run between $5,000 and $15,000, depending on the size of your home and system type. Water heaters last about 8 to 12 years and run $800 to $2,000 to replace. Electrical panels, if yours is older and undersized, can cost $2,000 to $4,000 to upgrade. Plumbing in older homes, if it's original galvanized steel, will eventually corrode and may need partial or full replacement, a project that can run anywhere from $2,000 to $15,000 depending on scope. None of these are surprises. None of them are unfair. They're just the cost of having a house that works. But the problem is that when you're running the numbers on whether you can afford a home, you're probably not thinking, and in year 7, I'll need to replace the furnace, and in year 12, the roof, and also the water heater goes sometime in here. You're thinking about the mortgage payment, the down payment, and maybe the property taxes. The $47,000 worth of system replacements over 15 years, that tends to live in a mental drawer labeled, "We'll figure it out." The way to actually approach this is to find out, before you buy, the approximate age of every major system in the home. The roof, the HVAC, the water heater, the electrical, the plumbing, if possible. Then build a rough replacement timeline. If you're buying a house where the roof is 18 years old and the furnace is 14, you're probably buying a house that needs a new roof and furnace within the next few years. That's real money. Either price it into your offer or make sure you have it accessible. HOA fees, the monthly surprise that surprises nobody but still gets people. Let's talk about HOAs for a second, because I think they deserve more nuance than they usually get. Homeowner association fees get a bad reputation, sometimes earned, sometimes not. If you're buying a condo, a townhome, or a home in a planned community, you're almost certainly dealing with an HOA, and the fees vary wildly. Some HOAs charge $50 a month and mostly enforce lawn height rules. Others charge $800 a month and cover exterior maintenance, amenities, water, insurance, the whole thing. In high-cost cities, condo HOA fees above $1,000 a month are not uncommon. The issue isn't the fee itself. The issue is what the fee is actually funding and whether the organization is funding it well. Every HOA should maintain a reserve fund, essentially a savings account for large capital expenses: new roof on the shared building, repaving the parking lot, replacing aging elevators. When an HOA is well managed, the reserve is fully funded, and when things break, the association covers it. When an HOA is poorly managed, which honestly happens a lot, the reserve is underfunded, and when something major breaks, you get a special assessment. Special assessments are exactly what they sound like, an extra charge levied against all unit owners to cover an unexpected or deferred expense. I've seen special assessments of $500. I've seen them of $50,000. If the building you just bought a condo in has a badly deferred structural issue, a failing parking deck, a deteriorating facade, failing pipes, and the reserve can't cover it, every single owner is on the hook for their share. No vote required. It's in the HOA documents you signed at closing. Before buying any property with an HOA, get the financial documents. Look at the reserve study, a formal analysis of the reserve fund's health relative to projected future costs. If no reserve study exists, or if the reserve is funded at less than 70% of recommended levels, treat it as a significant risk factor. Utilities, the part nobody budgets seriously. I know, utilities seem obvious. Of course, your house has utility costs. But here's what catches people. The scale of the change between renting and owning is often much larger than expected. When you're renting, especially in a smaller apartment, your utility costs are bounded by the size of the space. Your landlord also has an incentive to at least not have things that are catastrophically inefficient, because in some leases or markets, the landlord absorbs some utility costs, and modern apartment construction tends to be reasonably well insulated. Older single-family homes, though? Oh, they have stories to tell, and most of those stories involve drafty windows, under-insulated attics, heating systems that work hard and inefficiently, and a gas bill in January that makes you feel personally targeted. The actual utility costs for a given home depend on the home's size, age, insulation quality, local climate, local utility rates, and your personal usage patterns. But a reasonable, rough rule of thumb is to budget between $200 and $600 a month for a typical single-family home, with older homes and extreme climates tending toward the higher end. That's $2,400 to $7,200 a year that doesn't appear in your mortgage payment. And something worth noting, utilities keep getting more expensive. Energy costs have risen significantly over the past decade and are generally expected to keep rising. Building improvements like added insulation, upgraded windows, or a more efficient HVAC system can reduce costs meaningfully over time, but those upgrades cost money up front. It's a long-term investment that pays off, but it's still a cost. The opportunity cost nobody talks about. Okay. This one's a little more philosophical, but I think it's important enough to include. When you buy a home, you lock up a significant amount of capital in an illiquid asset. Your down payment, your equity as you pay down the mortgage, the money you spend on improvements. All of that is money that is not invested elsewhere. And while real estate does appreciate over time, the actual return on owning a home, when you factor in all the costs we've been talking about, is often lower than people assume. Robert Shiller, the Nobel Prize-winning economist who literally created one of the most widely used home price indices, has pointed out that when you account for inflation, the long-run real appreciation of U.S. residential housing is actually quite modest, historically around 0 to 1% per year in real terms, over the very long run. The last 20 or 30 years have been exceptional in many markets, which has given people a skewed sense of housing as an investment. Now, I want to be clear, there are real financial benefits to home ownership. You build equity, you lock in a fixed housing cost if you have a fixed-rate mortgage, there are tax advantages in some cases, and after the mortgage is paid, your housing costs drop dramatically. These are real. I'm not arguing against buying a home. But I am arguing against the narrative that a home is a guaranteed, excellent investment that will make you rich while also housing you. That framing causes people to stretch their budgets in ways that leave no room for the actual costs of ownership. And when the costs come, and they always come, there's no buffer. Money spent on maintenance isn't lost, but it's also not money that's compounding in an investment account. The opportunity cost is real, and building it into your mental model of homeownership leads to better decisions. The emotional tax of homeownership. I want to end the main content here on something that's rarely quantified but genuinely matters: the emotional and cognitive cost of owning a home. I'm serious about this. Homeownership is a source of deep satisfaction for a lot of people: pride of place, stability, the ability to make your space your own. That's real and valuable. But it's also a source of chronic, low-level stress that renters simply don't experience in the same way. The water heater noise I mentioned at the start of this script, that's a real story. Not mine, technically, but a composite story of probably 10 different conversations I've had. That particular kind of stress, the what's that noise, what does it mean, how much is it going to cost, can I afford it right now, should I call someone, am I being paranoid, spiral is a genuine feature of home ownership. It doesn't go away, you just learn to manage it. There's a concept called cognitive load, the mental bandwidth that's used up by an ongoing source of complexity or concern. Home ownership adds to your cognitive load in ways that are hard to quantify but very real to live with. You are always, to some degree, managing the house, thinking about the house, worrying about the house, planning for the house. This isn't a reason not to own, but it is worth acknowledging, especially if you're the type of person who genuinely thrives with the stability and pride of ownership, who can tolerate the surprises without spiraling, and who has the financial cushion to absorb what comes. Then owning is probably right for you, and these costs are just part of the game. If you're financially thin, risk-averse, or likely to be in a city for only 2 or 3 years, renting might actually be the smarter, more financially sound choice, and that's okay to say. There's this version of home ownership that gets sold to us in soft-focus TV commercials, a couple standing on a porch, laughing, completely at ease, like the house handles itself. And I think a lot of people carry that image with them right up until the first time something breaks. What I want for you is the real version, the version where you went in with eyes open, where you ran the real numbers, where you set aside the real money, and where the noise from the water heater is a Tuesday inconvenience rather than a financial emergency. The difference between those two experiences isn't luck. It's information, it's preparation, it's understanding that a house is a living thing that asks things of you, financially, emotionally, practically, and deciding to meet those demands with a plan rather than hope. You can do that. You just have to actually want to know the full picture. And the fact that you sat through this whole thing, I think you do. Go figure out your real numbers. Then go buy the house, if it makes sense. And when the water heater makes a noise, you'll be ready.